So recently I made a video on my absolute favorite longer term moving average to give people an idea of how they can use a straightforward tool to kind of sort of time the longer term entries in the market so that it decreases the volatility. And we had a lot of questions on that video, which I'm very happy for. So thank you for all the questions. I wanted to follow up on that video with a couple of clarifications or little additions, and also looking at it in terms of the current market environment. So before we look at the chart, let me just quickly talk about sort of the point of the indicator. The point of the indicator wasn't so much to say that you have to use it for any little tiny correction. In fact, it only really starts to work when you have bigger moves in the market that sort of then break, say on an equity index, breaks it below the index. So what it really does, it takes out the volatility of your returns and then gets you back into the market as we start trending higher again, just like it takes you out of the market as you start breaking lower from a longer term trend perspective. So it takes out the volatility. That's really a big deal. So speaking of which, we currently have a juncture where we are revisiting that moving average, and I want to just kind of show you what this looks like right now on the S&P 500. So I'm going to flip the chart, and what I created here is really just, again, a very simple chart of the S&P 500, and I want to show you where we are right now and how that compares historically to a couple of other junctures where we saw, I think, something rather similar. So you can see, for example, here in October 2000, we had the S&P break below that 17-month moving average. It's the 17-month moving average we're talking. It's a simple moving average, by the way, 17-month simple moving average. That's one of the questions we received a lot. And it then ultimately retested it. And I can zoom in a bit closer so you guys can see this. It retested it, and then we broke lower and broke below the trend line as well. I drew a very simple trend line in here. The same thing happened again in early 2008. We broke below that 17-month moving average, retested it from below, and then also subsequently, as a result, snapped below the trend line. And it is, in my opinion, happening again right now. And we'll talk about some of these other points in the market here as well in just a second. But you can see we broke below that moving average. By the way, we extended way above it, which is one of the things that makes it more concerning at this point, i.e. that we could see lower lows. We revisited it just recently, like the past couple of days, couple of weeks or so. And we are now looking to break below that blue line, which would be a break below the longer term trend. Now, you might note that in neither of these situations did we break below trend, so that's number one. But also we had a very different economic environment here, and arguably even in early 2018 than we have now. Okay, so this is where we start using a fundamental and structural approach, and we overlay it to something as straightforward as a moving average. So in my opinion, not really until we break below this line here are we really going into the actual bear market. And this I know this sounds crazy, but and I mean on a monthly closing basis, right? These are monthly charts. So we would have to break below this blue line on a monthly closing basis in order for this entire trend to change. And again, then the 17-month moving average, which is what we're looking at here, would have been the initial sort of telltale. Ultimately, how low could we go? You know, I currently assign, and you know, we tell this our clients every day, we assign about a 30% chance, 30%, so clearly it's not my base case, 30%, that we could see something in the 1500 to 1800 area on the S&P. Again, it's not my base case, so hold your hate mail. It's not the base case at all, about a 30% chance. Why a 30% chance? Well, because of everything that we just saw, but we haven't yet actually broken trend. Okay, so this is how we use the 17-month moving average. What's interesting so far, again, to quickly recap, is that we've broken below it, we've retested it, but we now need to see more weakness to really confirm all this exactly as it happened here and here. Hope it helps. I'll see you soon.